So, in this session, we want to talk about liquidity. Imagine that we have a downtrend and we're currently in a downtrend. The market keeps making lower highs at some point. You see that the market breaks past the previous highs. At this point, you might think that this is probably a change of character, and your expectation is that the next move will be for the market to go up and turn bullish, but you see that this move still results in a sell. What this move means is that in order for the market to find more sell orders to continue its movement, it needs to come down. It's about the stop losses of the sellers. The market takes out the stop losses of the sellers who are positioned here, providing liquidity, and then the seller's move can continue. Similarly, in a buy scenario, you've often seen that the market is moving upward, it's bullish, but at a point where you think there have been several changes in character. Will it break this level? Will the move continue? In both of these situations, meaning in this is the situation that has happened here or here that we're talking about, basically, the market has played a trick here, which we identify as a deception or an inducement. But the general idea is that the market needs liquidity to continue its move. Liquidity is usually represented by this symbol in the market, and this means that, in fact, there is liquidity. At this point, liquidity gets grabbed and the move continues. So now, in order for us to be able to identify liquidity, there are several important types of liquidity, and in the classification, they say the first type of liquidity is called, in fact, we call it swing liquidity. Behind every high and low, behind every high and low, there is liquidity. This could be a supply zone. There could be a supply zone here that has formed in the direction of the sell side. Our view is that the liquidity here will be grabbed in the direction of the buy side. Usually our expectation is to come and grab the liquidity here. This liquidity gets hunted, so these 2 points in the swings can be liquidity points. Anywhere in the market, you can find a swing and observe liquidity. Regarding the type of liquidity that is common, we call it liquidity. Equal highs. Or equal lows. The first one is represented by the abbreviation EQH and the second one by the abbreviation EQL. So what exactly does that look like in practice? In fact, in the context of equal highs liquidity, they specifically call it equal highs when there are precisely two distinct highs. And crucially, the second high is noticeably lower than the very first high, indicating a clear pattern where subsequent highs are consistently lower than the initial high point. We call this an equal high, and here we say there is liquidity. The second type is equal low, but for equal lows, the second one must definitely be higher than the first. So if I see this in an uptrend and this in a downtrend, it's because you know that the next likely move will be in the opposite direction. The reason for this point is that the mover comes and takes the liquidity behind the trend line. Many people think it's over and the move will continue. So, because this can actually happen at this point, we still have liquidity here, meaning it's not below this trend line. We generally only refer to two types of high and low values. Here, there is what's called equal liquidity. This area is referred to as equal liquidity. And we should mention that in this type you see here, again, there is liquidity present here. Usually to represent it, we use EQH. EQH is used. For the two highs, just pay attention that these highs drawn here should not actually be higher or lower than the other one. This is what we call equal high liquidity. This particular one is also an equal high, and this represents the third distinct type of equal liquidity that we frequently encounter. The definitive proof of this specific type of liquidity is clearly demonstrated by trendline liquidity. That is to say, imagine there are more than just two. Suppose you currently have a developing trend, yin yi, equal chaos, yin yi. A downtrend in the market. A descending trend line has formed here, and we are actually seeing it visually, meaning there have been more than two touches. Our expectation is that after this period where this liquidity has formed, our expectation is that if the market breaks this area, it should be bullish. That is, after this, we expect the market to turn bullish. But what usually happens is that the market continues its bearish move. In this case, we refer to these highs that have formed, meaning the presence of several highs that can create a trend line, as here, in fact, we have TLQ. We have trendline liquidity here, which is also known as TLQ, and its type is exactly this. Basically, the market is overall bullish and you're seeing an uptrend. The market is moving within a channel, but what usually happens is that the trend line you have here breaks, yet the market doesn't turn bearish. That is, after the breakout at this point, you see the continuation of the buy movement. And this continued buy movement means that, in fact, we also have a TQL and TLQ here. This is the area that I've actually drawn. So, three of the most well-known swing formats are EQH, EQL, and TLQ. The fourth type is liquidity, liquidity, liquidity in daily, weekly, and monthly candles. That is, our daily candles. And the significant weekly and monthly candles, these are also very good and important points for us to consider. They clearly represent areas of significant liquidity. Imagine, for instance, that right here we have a prominent daily candle and our overall market. You say, that is bullish. Suppose this is a daily candle. It doesn't matter. Now, whether it's daily, weekly, or monthly, always picture the liquidity of the bullish candle here. Imagine that the liquidity of the bullish candle is located in this area, which is actually the candle's liquidity. That is this point once again. The fifth type of liquidity that we want to discuss is actually session liquidity. You know that in the market is made up of different sessions, like the Asian session, the London session, and the New York session. The best place for us in terms of liquidity, one is the Asian session, and the other is the London session. These are the two sessions that I'm drawing here, and you can identify them using certain indicators. This is the London session right here. We draw it here. The London session or the Asian session are both very good points for you to find the market's liquidity. For example, suppose in the Asian session, the market usually forms a trend that is either ranging or bullish. Most of the time it's ranging or bullish. Then, when you look at the London session, since the trend has been upward, this area actually contains buy-side liquidity. And it's exactly the same in the London session as well. That is, these two sessions are usually hunted from one side and then the movement continues. Now, this is basically what is generally said in the classic form about liquidity. We want to identify this liquidity with the help of an indicator, POI. In the POI tool, as you know, when they use this POI tool, first they set it to the leg mode. When they set it to leg mode, we know that the market actually moves to its higher level and it creates a zone for them where I expect a drop from the middle line. What usually happens is that the market doesn't reach that zone. Instead, it comes here to a liquidity area like equal highs or liquidity. It creates a boundary line. If you see, by placing a POI between this zone and this zone, between these two that we define, this is drawn. And now your POI is above. What does this become for you? Liquidity. For example, suppose when we have this zone in, we have the option to assume, for example, that I have this zone or I have that zone. I want to see what liquidity exists from here to here to understand the liquidity. That's enough. I just need to click on the POI box indicator here. Now I'll add the POI box indicator. From here to here, as you can see, from the start of the market, we don't even need the DP. We'll turn off the DP as well. As you can see, the market should have come and reached this level. It should have reached this level. So all of these become liquidity for us. These are now all liquidity. Liquidity, liquidity, and waiting. We expect the market to bring itself to these zones so that we can actually have the next move. In relation to the topic of liquidity, now again, I want to look for a bigger liquidity from lower down for the main buy move. If I start from a lower point and set the starting point. Now, what happens is that I set this at the lower point and I put this one as well. I truly want to go to the absolute highest point. In the current significant price uptrend where I am positioned right now, I need to consider where in this dynamic market could there potentially be substantial liquidity. The transfer log tells us that when from down here, we look up until the price exits the box once and settles on the middle box. You need to move the low price. Now I can move the low, and in this situation, I say the market has transferred from this point to this point. In the next scenario, if you pay attention again, when I look at the market from here, it went up once, settled down here, moved upward, and again, the same thing happened. I need to move this forward, bring it here, and again, I have a transfer here now. In the next step, if you pay attention, it hasn't settled on the middle line, and since it hasn't, I don't have a transfer here anymore. That is at the last point where there was a transfer. When I measured this one, since there was a transfer, this one was also transferred. After this, I don't see any more transfers in the buy or sell, just like now. As you can see, here and here there was no market low. We actually call this place where the last transfer happened, the last point. So here we have a true low, and in the market's true low, we can now consider this final one as the better final point for buying. Buying would be around here, and the optimal point is the middle line. And all of these now could just be liquidity, and we don't use liquidity for trading. There might be some reactions, but for us, these are not the final or main points in this part of the market. I'll draw these again and show you myself so you can see what has happened so far. Let's assume that this is the lowest point of the market, which has led to a BOS, break of structure. I'm looking to find the liquidity grab here from above and below. If I put this here and put that there, as you can see precisely, none of these moves after leaving this area were able to take out this level. So what I have right now is there's no transfer at all. Here, this can be a low for me, or actually the real low, or an internal low. So when I see this, all of these have been liquidity. The market came and grabbed all the liquidity that was there. This point is the one we should be looking for as the real one, and then the continuation of this move. Now, if I look at it from the sell side, up to this point where the market dropped again, this is now the high for me. What I'm seeing is a high, just as you can see. This couldn't reach this level or the band. This is also a high. Another high as well. So, considering the entire path that's here, it could be liquidity for me. It's possible. If the price reaches this area, none of you should sell. These highs actually create more attraction for liquidity. Because the target, the maximum buy target I can take here is the POI of the existing bearish leg. Well, of course, we know that in fact we are supposed to be behind all this logic. Later we will trade after seeing the DP, but the first format, the one we need to learn, is how to trade in the market. The point is, whenever we want to look at the market, our assumption is that first we need to make sure that this is a low or a true low. Identifying whether it's a low or the true low tells us where the liquidity is and from where we should start drawing the leg. Now, for example, if your market is drawn like this and all those 50% levels are taken out, in this case, this is a transition for you, and the condition for a transition is that it must take place within a POI. In the next session, I will explain more about true low, true high, and the concept of transition.